Are you feeling ignorant about your own hotel's financial well-being? Would you be able to detect danger signs in the financial health of your hotel? Were you aware that picking up these danger signs in your hotel's financial well-being is a critical skill for a hotel manager, and it is guaranteed to get you elevations and promotions, ultimately success. However, most hotel managers have no understanding of the financial health of their hotel. Ability to detect early warning signs is actually a leadership strength. But most hotel managers tend to ignore this critical leadership strength. Because of that, their promotion and elevation opportunities become limited by their own actions. I will show you how you can easily identify early warning signs of your hotel's financial health. You would want that, right? And we'll be using a very simple technique. However, your peers would not know about this, so you will have a head start on them. And this technique will boost your chances for promotions, elevations, and all kinds of opportunities. Now, you may have a question. Why me? I spent 26 years in the hotel industry in senior finance and leadership roles. I have myself detected hundreds of early warning indicators. Moreover, I have personally shared this with hotel managers and got them to identify them too. And that led to successful analysis and successful financial decisions. What if you were able to get a prior warning about the business performance? Wouldn't that be great? Particularly if it's something to do with your cash resources. Why is cash so important? Well, hotel needs to run its daily operation with cash. Liquidity ratios are those early warning signals that I talked about, the prior warning that you're getting. But what are these liquidity ratios? Let's find out. And before that, let's see what liquidity itself is as a concept. Liquidity simply means how quickly an asset can turn into cash. And now you can understand the cash resource importance. A hotel needs cash, obviously, to run its operation. And current assets of a hotel provide that much needed liquidity. But what are current assets, first of all? Let's take a look at the balance sheet of Paradise Hotel. Current assets form part of the balance sheet, and current assets provide cash resources. Hence, current assets end up providing liquidity. Current assets can include cash, short-term investments, accounts receivable, inventories, all of which we are going to see shortly. Let's find out about a key type of liquidity ratio, and that is working capital. What is working capital? It's a critical liquidity measure and uses total current assets and total current liabilities of a hotel. Let's see what the formula for working capital calculation is. We will be using the 31st December 2018 to calculate working capital. So the formula for working capital is current assets less current liabilities. Now, you would notice a similarity between the current ratio and the working capital. Well, the working capital is kind of the dollar equivalent of a current ratio. Both take current assets and liabilities, but in a different way. We will see how. So the numbers are, as you can see, as of 31st December 2018. So the working capital works out to be 28,800. So what does working capital of 28,800 mean? Well, it means that the working capital is showing you how much of current assets are left after deducting current liabilities. In a way, you could call it the net current assets. And as I said earlier, working capital is the dollar equivalent of the current ratio cushion. Remember the current ratio cushion? The current ratio cushion is when you divide current assets by current liabilities, and the resultant ratio tells you or gives you an idea of this cushion. Let's get back to working capital. Why is 28,800 working capital not very great? Well, because current assets cushion here is only 15%, which is the difference between the current assets and the current liabilities taken in a percentage calculation. The ideal cushion, if you remember from the current ratio, current assets should be twice current liabilities, which means a cushion of 100%. Against 100%, you have only 15%. But everything is not totally lost. Let's see the situation in the next year. So this is the 31st December 2019. Current assets, as you can see, are being shown. And again, we calculate current assets less current liabilities. Applying the numbers, we get 124,000. So the working capital for 31st December 2019 is 124,000 compared to 28,800 the previous year. And what does it mean in terms of current ratio cushion? Well, you notice that the 1.58, which is the difference between the current assets and the current liabilities taken as a ratio, means that current assets are higher than current liabilities by 58%. And that's the cushion that we talked about. In the case of the working capital of 124,000, it's equal to a current ratio cushion of 58%. And that's actually very good. Now, a quick point which I've been repeating actually is that current ratio is the working capital stated as a ratio. How so? Well, current ratio divides current assets by current liabilities, while working capital deducts current liabilities from current assets. Both are using the same two indexes. So, in a way, both are measuring net current assets. And we will notice that the current assets will be used to pay off the current liabilities. And how do we do that? Well, this is by collecting the accounts receivable and selling inventories. We will learn about this later in the video. So a working capital of 124,000 net current assets is good as of 31st December 2019. We will be using the same yardstick as current ratio for working capital. So what should a current ratio ideally be? Current ratio of 2.0 is considered good, or current assets should be twice current liabilities. Let's get back to the Paradise Hotel working capital. So you have a working capital of 124,000 after paying off current liabilities. Current assets of Paradise Hotel have improved in 2019 compared to 2018. But a question arises, are all of Paradise Hotel's current assets equally liquid? Each current asset actually has a different liquidity level. Cash, of course, is the most liquid current asset. An important fact to note about current assets and their placement in the hotel balance sheet. Current assets are placed in order of liquidity. That means the most liquid asset first, and then the second most, and so on. And that's why you notice that the cash is listed first. Let's see Paradise Hotel's other assets liquidity. Short-term investments are second in line after cash. These are actually money invested outside the company to earn income. And short-term generally means within one financial year. Next, the current asset accounts receivable is one of the most critical of current assets for a particular hotel. Accounts receivable are therefore third in liquidity. What are accounts receivable? Accounts receivable simply are sales made but money not collected. Accounts receivable have to be managed well so that the cash flow is positive. Let us analyze this accounts receivable for the Paradise Hotel in a little more depth. We'll be using AR as an acronym for accounts receivable. Notice the AR balances as below. On 31st/12/2019, its balance is 140,000. The previous year, 31st December 2018, it used to be 90,000. So, in a way, AR balances have increased 2019 versus 18. What's the net effect of this increase in AR? Well, cash flow decreases. Why? Because you have collected less. And so, an increase in an accounts receivable is a negative effect on cash flow. That's a warning. You could call it an early warning signal for accounts receivable. Remember, we are talking about hotel financial ratios, which are early warning systems, right? So it shows that it's not being managed very well. Now, what is the deal with the accounts receivable? Generally, the credit department is responsible for collections, and so it's responsible for also managing accounts receivable. AR balances generally should not increase year to year. This is because when an AR balance increases, collection decreases. And when collection decreases, cash flow decreases too. This means you have less cash resources to pay off your current liabilities. The next current asset, inventories, are equally critical. Inventories are fourth in liquidity. And what are inventories? Well, they are goods purchased, not yet sold or consumed. Inventories also need to be managed so that cash flow is preserved. Let us do the same analysis for inventories as we did for accounts receivable. Inventory balances are as follows. 31st December 2019, 15,000. 31st December 2018, 17,000. So inventories have actually decreased as opposed to accounts receivable, which increased, if you remember. Now, the net effect of a decrease in inventories is that cash flow increases. Cash flow is made better. This is a good sign that inventories are managed well. Let us address an important question while we are talking about the current ratio. Why are accounts receivable shown ahead of inventories? Well, accounts receivable is sales made, money not collected, while inventories are not sold at all. So liquidity-wise, accounts receivable is on a higher level than inventories. Inventories are actually considered the least liquid of current assets. Because they're considered the least liquid of current assets, a related ratio called quick or acid test ratio is also calculated. And what does it do? Well, it simply removes inventories from current assets or from the current ratio. And so the formula is current assets less inventories divided by current liabilities. So the current liabilities remain the same as for the current ratio. Quick ratio or the acid test ratio gives you a more accurate reflection of liquidity. The next current asset are prepaid expenses. These are quite common for any hotel. They are the last year in liquidity. They are generally payments made in advance for goods purchased or services rendered. Prepaid expenses also need to be managed so that cash flow is preserved. Let us now take a step back and understand what current liabilities are, which we used in our current ratio by dividing current assets by current liabilities. Notice the current liabilities as below. It's 214,000 in the year 2019, and it's 192,200 in 2018. So current liabilities have also increased. That means you have to pay more current liabilities in 2019 than in the previous year. But the current ratio of 1.58 for Paradise Hotel is reasonably good. And why is that? Because as you can see, the comparison between current assets and current liabilities over the 2 years, 2019 and 2018, the 1.58 current ratio is contributed by higher increase in current assets than current liabilities. That is always a good situation. Now, let's look at what's included in current liabilities. Accounts payable, as you can see, these are the balances for the 2 years. And here, what are accounts payable? Well, accounts payable are what the Paradise Hotel owes its suppliers. Generally, suppliers allow 30 days for payment. Because accounts payable have increased, more current liabilities need to be paid off in 2019. Next comes accrued income taxes, whose balances are as follows. Accrued income taxes are simply monies owed to the Inland Revenue Service for income tax. And accrued expenses, which follows accrued income tax, is similar, although they are estimated expenses payable by Paradise Hotel. Let's now look at the last item in current liabilities, which is kind of unique. It's the current portion of long-term debt, and these are the balances. Well, current portion of long-term debt is simply what is owed by Paradise Hotel within the next 12 months out of the total mortgage loan. So the current portion has increased. This means that either an installment has not been paid, which is not a good thing. Always compare your working capital between years. This will tell you whether your working capital has improved 1 year to the next or has deteriorated. This is very important. Apart from that, you need to ensure that current assets are as close to 2 times current liabilities as possible. And also that current liabilities are not increasing over the 2 years. As a result, the working capital must ideally reflect 2 times current assets in terms of current liabilities. Now let's come to something unique about working capital in opening hotels. What is special about opening hotels compared to an operational hotel? Well, an opening hotel does not earn revenue. And in current assets, cash comes from earning revenue. So how do they manage? Well, because they cannot generate cash flow of their own, they depend upon the owners to provide the funds. And so these working capital requirements must be estimated realistically. And so the owners place a lot of importance to this important element. So opening hotels tend to depend on owners for their working capital until the hotel opens. Let's now summarize our hotel working capital video. So there are three important takeaways. The first is that working capital is current assets less current liabilities. Ideally, current assets should be 2 times current liabilities. And in the case of opening hotels, working capital is critical because it's provided as funds by the owners. Would you want to know more about the power of hotel financial ratios, what I call the early warning systems? Well, watch this video on the ultimate guide on hotel financial ratios.